Carbon credit volatility is breaking corporate hedging. For several years, carbon credits functioned as a relatively tractable line item in corporate sustainability planning. Companies committed to net zero targets built decarbonization roadmaps and assumed that the residual gap between operational reductions and stated goals could be bridged through the voluntary carbon market at reasonably stable costs. That model is under serious pressure. The voluntary carbon market contracted sharply from its 2021-2022 peak and has not recovered. Transaction volumes fell 25% in 2024 alone, and market value dropped to $535 million, down more than 60% from the peak period, according to Ecosystem Marketplace's State of the Voluntary Carbon Market 2025 report. At the same time, the compliance market in Europe has been significantly more volatile than many corporate planning assumptions anticipated. These are not temporary disruptions in an otherwise stable market. They reflect structural changes in how carbon is priced, what counts as a credible credit, and who will bear the cost of compliance as regulatory frameworks tighten. For executives responsible for capital allocation and net zero commitments, the core question is whether the financial assumptions underpinning their carbon strategies are still sound. The most consequential development in voluntary carbon markets over the past 2 years is not the headline price decline. It is the bifurcation of the market by credit quality. Credits representing actual emissions removals commanded a 381% price premium over emissions avoidance credits in 2024, up from 245% the year before. High-rated credits A to AAA averaged $14.80 per ton in 2025, while low-quality credits averaged just $3.50, according to MSCI Carbon Markets data. That spread is not a temporary premium. It reflects the Integrity Council for the Voluntary Carbon Market's rollout of core carbon principles, which have effectively rendered a significant portion of legacy supply non-credible for corporate net zero claims. The ICVCM rejected all legacy renewable energy methodologies in 2025, removing a large volume of low-cost credits from eligible supply. Companies that previously relied on cheap renewable or RED Plus credits to close the gap in their decarbonization math are now either repricing their strategies or holding credits that no longer satisfy the integrity standards their stakeholders expect. That quality shift is creating a structural supply problem. Allied Offset's data from the first 6 months of 2025 shows 100 million tons secured through offtake agreements and similar advance commitments, more than the entire voluntary market transacted via OTC agreements and exchanges in all of 2024. Companies that recognize the supply constraint are locking in high-quality removal credits years ahead. Those that have not begun that process face a tightening market for the exact credit types that now matter, at prices their current models may not reflect. The competitive dynamic this creates is visible in how capital markets are already reading carbon exposure as a forward-looking risk variable, not just a compliance obligation. The compliance market is not a substitute. For companies with operations in Europe, the EU ETS is not a hedge, it is a cost. EU ETS allowance prices averaged $70 to $75 per ton in 2024, down from a peak above $116 in 2023, but by December 2025 had rebounded to roughly $97 per ton, a 30% year-over-year increase driven by compliance buying ahead of tighter caps. Bloomberg NEF forecasts EU ETS prices at $156 per ton by 2030 as the emissions cap continues its mandated decline. The ESMA Carbon Markets report for 2025 confirmed that while overall EUA prices were down 22% on an annual average basis in 2024, this masked significant intra-year swings, correlated with natural gas prices and auction volumes, factors largely outside corporate control. For finance teams modeling compliance costs more than 12 months out, that correlation introduces a second order of volatility beyond carbon pricing itself. The regulatory perimeter is also expanding. ETS2, which extends carbon pricing to buildings, road transport, and small industrial operations not currently covered, launches in 2027. The Carbon Border Adjustment Mechanism, CBAM, entered full compliance obligations for EU imports of steel, cement, fertilizers, and other covered goods in January 2026. What the hedging model actually assumed. The core problem is not that carbon markets are volatile. Commodity markets always carry volatility. The problem is that corporate carbon strategies were frequently designed around assumptions that no longer hold, that cheap avoidance credits were a sufficient proxy for climate action, that voluntary market prices would remain low and liquid, and that compliance obligations would move slowly enough to allow gradual adjustment. As corporate approaches to carbon credits have been forced to evolve, the companies most exposed are those that have not yet updated the financial logic underlying those earlier commitments. The market structure has changed in three specific ways that matter for financial planning. The supply of credible, high-integrity credits is constrained and becoming more so, not because demand has collapsed, but because legacy supply is being retired from eligibility faster than new high-quality supply is scaling. Removal credits, the category that major buyers now require to substantiate net zero claims, carry costs that are structurally higher and less predictable than the avoidance credits that dominated corporate portfolios in 2021. The over-the-counter bilateral transaction market for carbon removals has grown 27-fold since 2022, according to Bloomberg NEF, effectively moving the highest quality supply out of spot markets and into long-term contracted positions, meaning spot market access to credible credits is both thinner and more expensive. The planning adjustments that follow. For executives, these dynamics converge into a capital allocation question. How much of the residual decarbonization gap in your net zero plan is priced accurately? If that plan was built on 2021-era voluntary market assumptions, the cost of closing it is materially higher today and will be higher still by 2030. Companies that defer that reassessment are not avoiding a decision. They are making one, with implications that will surface in future financing discussions. Lenders and investors modeling transition credibility are already treating the gap between stated targets and credible procurement plans as a financial exposure. The practical steps are straightforward, even if the execution is not. Audit current credit holdings for ICVCM core carbon principles eligibility and replace non-qualifying positions before they create disclosure exposure. Evaluate whether entry into long-term offtake agreements for removal credits is preferable to spot market reliance, given current supply trajectory. The carbon market that existed when most corporate net zero strategies were designed has been substantially restructured. The companies best positioned to maintain credible commitments and defend them under investor and regulatory scrutiny are those that treat that restructuring as a financial planning input rather than a sustainability team concern. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.